Hello everyone and welcome back to the channel, where we're going to talk about the intricate world of stock market and break them down into digestible nuggets. Today we're going to dive into the realm of exchange traded funds, better known as ETF, and explore the one that's really making waves among retail traders. If the vast expanse of individual stocks has ever felt overwhelming, ETFs could be our solution. For retail investors navigating those muddy waters, identifying promising stocks can be a challenge. Limited information and technical barriers often obscure those potential gems, but fear not because ETFs are here to simplify the game. Think of them as treasure chests housing a variety of stocks with robust growth potentials. But instead of searching for that elusive needle in a haystack, you have the entire haystack, needles and all, at your disposal. So today, let's delve into one such ETF that's been catching the eyes of many retail traders. Different ETFs cater to different purposes, aligning with various sectors and investment goals. In a prior video, we talked about SCHD, the Schwab US Dividend ETF, a popular choice amongst investors. And today we're going to put it into comparison with another contender in the game, the Vanguard High Dividend Yield ETF, trading under the ticker symbol Vym, VYM, on the Nasdaq. Vym, or the Nasdaq High Dividend Yield ETF, acts as a financial superhero for many retail traders. It's been crafted to provide exposure to companies showcasing both quality and growth potentials. This ETF holds a basket of carefully selected stocks. It allows investors to tap into the success stories of multiple companies without the need of exhaustive research on each and every one of them. Not to mention that it only charges a 0.06% in expenses, which is remarkable, and it's almost 15 times lower than most other funds in similar nature. What further sets Vym apart is its focus on companies boasting strong fundamentals and a consistent track record of dividend growth. This blend of quality and dividend growth can be a winning formula for long-term investors seeking stability and income. So in this video, we're going to explore Vym, compare it to other popular options in the market, and discuss the best trading approach given the current circumstances. Before we jump into it, if you like what you see, please consider like, comment, and to subscribe to my channel. Also, check out the other video analysis that are organized on playlists on my channel page. With that being said, let's dive into today's video. Lately, Vym has been hovering around $112.50 range, showing a marginal 1% increase over the past 5 days, a more pronounced 4% increase over the last month, coupled with a 7% uptick over the past 6 months, reaching a bottom around $98.71. It's noteworthy that Vym has been on a pretty much sideways trajectory over the past 12 months, experiencing a 3% increase during that period of time. Currently, it is priced near the upper limit of its ongoing channel. Functioning as a diversified dividend fund, Vym holds a substantial number of positions recognized for their stability and brand power in delivering dividends to its holders. With an expense ratio of around 0.06, it's about at the same price of the Schwab counterpart SCHD, and with a lower yield as well, currently standing at around 3%. It's been operating since 2006, and it offers options for both hedging and exposure increase purposes. So another thing that may differ Vym from SCHD is that Vym seems to be even more diversified compared to the Schwab option, in the sense that it's less top-heavy. For instance, the biggest investments that Vym has holds around 3% or less in any stock, whereas for Vym, I think it's a bit high. For SCHD, I think it's a bit higher than that. So in that sense, I would say that Vym is a very diversified and resilient ETF to be had, and it can serve a bit more like a stabilizing force and presence in one's portfolio. With that being said, here's a quick look at the technicals. The trading volume of Vanguard High Dividend Yield ETF has recently been around 1.3 million shares versus the average volume of 1.4 million shares. During the past 52 weeks, the price fluctuated between $98.40 and $112.69. The volume of shares traded tells us how many shares are being bought and sold at any point in time, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be easy to influence the stock price, but low liquidity could also mean that the demand is limited for any sort of exit. When we compare the current volume against the average volume, there could be the possibility for trend reversal or breakthrough if the difference is too large. For example, if there's a breakthrough, the current volume would be significantly higher than the average volume. The assets under management of Vym is currently at around $51 billion, which in this regard is similar to what SCHD has on its own balance sheet. As we compare the current price to the historical price fluctuations, the price is 4% higher than the 1-month low, 14% higher than the 3-month low, and 14% higher than the 52 weeks low. On the options market, which often gives a hint on the market sentiment about where the stock price is going to head next, the implied volatility is 11%, compared to a historical volatility of 10%. The put-call volume ratio is currently at around 40%. It is normal for many stocks to also have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is around 194 contracts a day versus the 30-day average of 942 contracts. Regarding the open interest, the most recent volume of open interest is around 19,000 contracts compared to the 30-day average of 19,000 contracts. As for the shareholder structure, institutional shareholders own 38% of the outstanding shares. The biggest shareholders include the Bank of America, Morgan Stanley, and LPL Financial LLC. Usually, it's always encouraging to see institutional presence in any ETF or stock for the long term, because it offers a layer of stability and a token of reliability. It's worth pointing out that Vym seems to be held to a larger extent by the retail traders than many other ETFs that I've seen. Typically, they're more like around the 60 or 70% range, whereas in the case of Vym, it's more 40%. So I personally believe that the minimum threshold should be around 30% for institutional ownership for us to consider investing for the long term. The current short interest is about 304,000 contracts of the total float, 40% of which from the dark pools. If the short interest is about 15% of the total volume, with a significant portion of the shorts coming from the dark pools, this may suggest of institutional presence behind shorting operations, which also may enhance the potentials for a short squeeze. Currently, I don't believe that there is much of an argument for a short squeeze or a short operation initiated by the institutions, because simply the interest is far too low, and I don't see any sort of reason why anyone would go after Vym. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Overall, my recommendation for Vym is to consider it as an investment position that may play a stabilizing role in your portfolio, just like SCHD. In fact, if anything, it can be seen as an alternative to SCHD to hedge the risk from depending too much on one single ETF, even though buying one ETF is like buying hundreds of stocks at once. But of course, this is just an alternative to the other packet of 100 stocks. The timing may not be the best to commit the majority of your capital, so I would recommend a slow build-up over the next few weeks and month. That seems to be the best way to approach the whole situation. I would recommend to commit between 5 to 8% of your portfolio in Vym, and would recommend to put the allocation in batches of 10 to 20% over the next few months, so that you can profit from any sort of retracements